friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And we are two lifelong friends with a combined 25 years of experience working and teaching on Wall Street, here to give you the skinny on the world's highest paying careers and to let you know if the things that you see on TV in shows like Billions are in fact accurate compared to the reality of what happens at the most secretive hedge funds in the world. So last week we did our intro to equity long-short hedge funds with David Semenza. David's a peer of ours as a fellow millennial. He went to Brown. I think he was a few years below you, right, Kristen? A year or two
Just
behind
one.
you? Okay,
Just
got
one.
it.
So yeah.
And he's had a tremendous track record of investing and is now running his own hedge fund. Today's guest has a little bit of a different perspective. So we had the incredible opportunity to sit down with Kat Sosnick, and she ran portfolios of up to $1 billion at some of the world's most legendary equity long-short hedge funds, including Tiger Management, Pequot, and Perry Capital. So for those of you who don't know these names, Tiger was one of the first big hedge funds on the scene. I think it opened in like 1980, okay? It was founded by Julian Robertson, who came to be kind of a godfather figure in the hedge fund world of the late 20th century and the early 21st century. It was seeded with, I think, $8 million in capital. And at its peak, Tiger had something like $22 billion in assets under management. Their average annual returns were something like 32%, when the overall market was averaging like 10 to 12% over that same time period. And they only had 4 down years out of their 21-year run. Tiger was known for training some of the best minds in the business. And so after the fund closed, Julian Robertson then supported and helped seed some of the hedge funds started by his little acolytes, those funds and their founders. They're often referred to as Tiger Cubs. That's where that comes from. And so you've obviously probably heard of a lot of the Tiger Cub hedge funds. So our guest today, Kat, she's a specialist investor in the consumer retail space. She's going to share stories with us about how she applied her passion for actually investigative journalism into doing what she calls grassroots analysis at the core of all of her investment theses. And it's funny because when we asked her what she thinks of shows like Billions, which is, I guess it's allegedly based off of SAC or Kristen, as you call it, SAC.
Yeah.
She actually said she had to stop watching it because it hit way too close to home for her. So apparently it is probably quite accurate. I know just from the clips I've seen that there are a few inaccuracies, and there's obviously exaggerations for the purposes of entertainment. We'll get into all that when we do our review of the show. But she said that Andrew Ross Sorkin, who was one of the co-creators, knew Tiger intimately and replicated specific elements of the fund on the show. Like, I guess there's a therapist on staff, which no one else was doing back then. And again, full disclosure, I've never seen a therapist on staff in person at a hedge fund either. So who knows how common that is. But guys, Kat has some absolutely incredible stories from her investing history and her career, ranging from how she tried to hard pass on a meeting with Jeff Bezos that ultimately ended up making a huge difference in her life. She sniffed out fraud at companies like Theranos, and she actually survived stage 4 cancer and became a mom to twin boys, all while at the helm of $1 billion portfolio. So I am so excited for this one. I think it's a really fantastic counterpart to last week's amazing episode, to now hear the perspective of someone who has really seen the industry evolve over more than 3 decades.
And who also was a woman in the industry back at a time when women were not really that represented. Not that they are really represented now, but it was even more back then. So
yeah. All right, let's get into it. So we are joined here by Kat Sosnick. And Kat has been in the business for well over 30 years at this point, working for some of the biggest hedge funds of all time that are pretty much all household names at this point. Kat, you branched out on your own about 15 years ago as an independent investor, and you've also since launched your own productivity coaching and consulting business. As one of the first female analysts at Tiger Management back in the 90s, could you walk us through your story of how you got into finance and what your career path has been?
Absolutely. First of all, thank you for having me. I could have really used your podcast in the early 90s myself. So I'm really a big fan, and I listen to it, and I watch you guys on TikTok and Instagram. And I really love your content and the excitement that you bring to this beautiful industry and profession. My path was a little unorthodox. I came into the business through grad school. And before grad school, I was at McKinsey in Germany. And I've always wanted to do investigative journalism. That was my passion, but I wasn't really a great writer, and English is not my first language. I was born and raised in Germany. So I applied to Columbia School of Journalism. And as a backup, I applied to the business school. I really wanted to come to New York. I have always wanted to live my life here. I love this city. So Columbia was really my only option. And I got into the business school and I did not get into the journalism school. So that was really how all this evolved. And then when I got to the business school, I was really not that excited and enthusiastic until in year 2, I was introduced to a seminar by one of my peers who said to me, Kat, you would really love this seminar. It's like analyzing stocks and it's all about putting on an investigative hat. So
Right.
I had really no knowledge of Wall Street, and actually my major in grad school was marketing, like most females at the time. And so I took the chance. I applied for this class. There was like 300 applicants, and it was the advanced security analysis class. And it was pretty competitive to get into. There was only 15 students. It was taught by legendary investor Jim Rogers, who started the Soros Fund with George Soros back in the days. And the teaching assistants were all either from Tiger or from other leading hedge funds. So this was a really very prestigious class. I got in and I did really well in that class because it was all about being sort of a research analyst and investigating stocks. And it was exciting. Professor Rogers, Jim Rogers, was like a drill sergeant. He was really tough on us, and I really enjoyed that. And I immediately fell in love with analyzing stocks. And by the end of that semester, one of the teaching assistants, Patrick Duff, who was a portfolio manager at Tiger, said to me, well, why don't you work at Tiger over the summer and see if you like it? I had never heard of Tiger Management. I didn't know what a hedge fund was. And I really didn't have any other options. So I said, sure. And my peers were like, are you kidding me? Do you know what kind of an offer that just was? I'm like, no, I'm just going to do my best and see if I like it. So then I walk into 101 Park Avenue on the first day of the job, and I was just blown away by this office. And I was like, what just happened here? And my cubicle was just right next to Julian Robertson. Most hedge funds have an open office environment. Back in the early 90s, it was like cubicles around the perimeter of the office, and then our trading desk was in the middle, and it was like sort of the Star Trek environment. It was like in the movies. And back then, nothing was done digital. We weren't so online, so everybody was shouting all day. It was like a really pure trading environment, like in the olden days, not like this today when everything is sort of done through your computer. So I reported directly to Steve Mandel, who was the retail portfolio manager back then and now runs Lone Pine Capital. Since then also retired. And after that summer experience, they offered me a full-time position, and that was really my story.
And Kat, for our listeners who are too young to remember kind of the early days of hedge funds in the 90s that we're talking about, can you explain what Tiger Management was and kind of the universe of Tiger Cubs that evolved from it, which is now, I think, ironically, pretty much the only exposure that some young people coming up through the industry may even have to what the world was like back then?
Okay, yeah. When I started at Tiger, hedge funds were not part of mainstream vocabulary at the time. I think it was not until the early 2000s that if you worked at a hedge fund, you sort of were considered a rock star in New York City. So I really entered the business when it was still pretty secretive. And the culture perception of hedge funds was very different 30 years ago than what it is today. Tiger at the time was a very unique place to work. I can't really describe it as anything but feeling like you're on the top of the world every day, working with the smartest people in the business.
Mm-hmm.
And I think that having someone like Julian Robertson, who was such a big personality, having had that experience to work really side by side with him, it doesn't surprise me that so many of the analysts that went through the Tiger program have become so independently successful. I mean, just to give you an example, I never had a resume after working at Tiger. It just was like a badge you carried with you for so many years until this day, because it was just such a powerhouse to work there. And I also think that for me personally, being a woman in an industry where it was really so rare to see women in actual investment positions, I mean, not in marketing, not in fundraising, but actually making the decisions behind the portfolio, was still very rare at that time. I remember when I came out of business school, my final project in Jim Rogers' class was a company called CanStar. So they make the Bauer ice hockey skates. And in the late 90s, there was a very big trend with rollerblading. And they also made those rollerblading skates. So I did the analysis. There's a ton of insider buying. The financials looked great. I went to Tiger, and that was my presentation during my interview process. And then 3 weeks later, I presented it again during one of our morning meetings. And both Julian and Steve were like, this is a great idea. Next thing I know, I look at the morning sheets and we've accumulated over 10% of the company.
Wow.
Then we flew in the management, we met with them, and we liked what we were hearing, and we increased our position further. And then 2 months later, Nike took over the company and we had a 60% return. And that was my first start.
My God.
Wow.
Where else is that possible
That's awesome.
in your early 20s? So I feel like it was a place where everything was possible and there was so much support for idea generation. And there was really no hierarchy when it came to ideas. We always sat together on Fridays. We had idea lunches with the 25-person investment team, and myself and another woman were representing as well. And as long as you performed, and that's the beauty of this industry, this sort of small space that is the US long short equities buy side piece of Wall Street, as long as you performed, it didn't matter who you were. I always said to my young analysts, you can show up as a monkey. As long as you do well, it doesn't matter. And that's the beauty of being a woman in this industry as well, is that there's really no bias, because at the end of the day, your report card is always how you do. Mm-hmm. And I think one other thing to mention is I haven't really been able to be vocal about my professional journey because we are a very secretive industry. And as an analyst, you really work like you're in a vault. But if you think about it, there's no really interfacing with clients. We don't have to do the work that the sell side does, where we show up and have to publicly claim our investment thesis, and there's no marketing involved. So we really can function in this sort of isolated environment. And I can tell you, it doesn't matter who you are and how you show up. At the end of the day, it's your returns that matter. Mm-hmm. One thing that I love about your work is all this Excel training. Now, I will say I pulled something out of my storage box for this podcast, especially because the way we were trained at Columbia Business School back then in the early 90s to do our numbers in Jim Rogers' security analysis class that I just talked about was with these old school premium analysis pads. So we were not even allowed to use Excel. So I don't know if you could see this. I kept one of them because it was so much a part of how my journey as an analyst panned out, is that I had to always write it out in these pads.
Oh my
And
goodness.
so I have to thank Jim for that, and also for that rigorous training where his mindset was always to drill it into us that every time you go against panic, you will be right if you can stick it out. And when you learn that so early on in your career, it basically helps you be a devil's advocate, which is so necessary for doing well on Wall Street on the US long short equity side, or maybe in, universally in business, if you can be a contrarian, it helps. So he really drilled that very early on into us.
Go against panic. What do you mean by that?
So it basically is a phrase that I use a lot with my analysts as well to describe how to think about a stock when it is collapsing in your face, and to take a step back and realize that if you understand the thesis and the analysis and you can do a quick test of the thesis, that is the best time to buy. Or, another way to say it is Rockefeller, that quote, make money when there's blood running in the streets. I mean, it's easier said than done, but after 30 years in this business, I am constantly still surprised that people will not buy a stock like Disney when it's collapsing, and then they will, everybody's a long-term investor of Nike or Disney at the top. And then when the stock collapses, it's like everything is wrong with the company.
Mm-hmm.
It's still the mindset of these extremes and these bipolar kind of mindsets that come with being a stock investor have not changed. And that's why there's always an opportunity set on Wall Street when there's a big pullback or panic.
I own one share of Disney.
But Kat, how do you specifically build the rigor to know the difference between buying a dip and catching a falling knife? What specifically in your analysis tells you that something is a smart time to add versus I'm going to step back and let these people figure it out before I step in?
I was fortunate because I was highly specialized from the very beginning. Even back at McKinsey, I was retail consumer analyst. And so I've always advocated for specialization, because what happens over the years is that you build muscle memory in these narrow group of stocks, and you know them so well that you know exactly when to step in, and you understand them thoroughly. That really is something that comes with time and training. And so I always recommend that if you want to have a career in long short US equities, pick a sector, because for me, that really has made all the difference. And it also allows me now, 30 years later, to wear two hats professionally, because I can look at my screens in the morning and say, take Disney, for example, a year and a half ago, stock collapsed. Oh, nobody's going to be watching Disney Plus anymore. They're losing so many subscribers. These doom and gloom scenarios in these huge companies very rarely pan out. So I've got my models. I've run those models for so many years now. I see where the red flags are. I see where the pain points are for the company, and I can understand when to step in. Now, that doesn't always work. There are secular shifts in every industry. For example, in mine, it was, the big box retailers like Bed Bath & Beyond. And that's where you have to step back and say, okay, what's the big picture look like here? That's catching a falling knife if you start to buy into companies like that, because your expertise should really be telling you that there is competition online, and these big box retailers may not be able to reverse that. And so that all comes with experience and paying attention, and again, being highly specialized.
So talking about that specialization within sectors and within individual baskets of stocks, I'm curious to better understand the structure of these investment firms that you worked at. In our Equity Long Short Hedge Funds 101 episode, which we did last week, we talked with the portfolio manager of a single manager fund. My understanding is that most of the funds you worked at had multiple portfolio managers. How did that work as far as specialization and also as far as competing for capital? Because I imagine that there's obviously some allocation within these multi-billion-dollar hedge funds of, okay, we're going to allocate so much to consumer retail, we're going to allocate so much to tech, so much to other different sectors. I'd really love to understand how that's navigated between the different portfolio managers.
Yeah. So in a typical long short US equity hedge fund, it depends on the size as well. I happen to have worked for three very large sized funds. So the primary issue there is the bigger you get, the harder it is to move capital for performance because you can't pick those triple baggers anymore that are small or medium sized cap
Wait, what's
stock.
a triple bagger?
Yeah, or I don't know.
What does that mean?
You're a
I've
smaller
never heard that
fund or
term
double
before.
bagger. So you got to move capital. And so your allocation is going to depend on how much opportunistic market cap there is in your sector.
And just a quick editor's note here, since we try not to use any terms without defining them, a double bagger or a triple bagger in this context means an investment that has gained 2 or 3 times its original value.
And during my time in the 90s, that was healthcare and retail to a certain extent, financials, and some of those sectors were always at the top of the sheets in terms of capital allocation. Now, there was a big shift in the late 90s, as you probably well know, and that was the dot-com era. And so that is when I was able to go in and basically advocate for more capital in the retail and consumer sector because we had some big companies go public back then in the very early stages of growth. And so the capital allocation process for me became a lot easier. So at the end of the day, I will say that capital allocation very much depends on the opportunity set within the sector, as well as your idea generation, how that is vetted amongst the investment committee.
So Jen was talking about the structure of some of these multi-manager funds. I'm curious, are there other PMs that also were, say, focused on consumer retail or not? Because I would assume that, like, let's say you find an opportunity and you think, Disney's down, I want to put money in Disney. If there's some other PM who also says that, now is it possibly, you guys are going to have too much beta, like there's too much correlation to this one particular name, which, like, if you're managing all the PMs, maybe you don't want that. Is it sometimes hard to find an investment because someone else has already got that idea? If you can walk us through a little bit of how the different specializations of the PMs work, that would be really helpful.
So we had this very issue in the late 90s when the dot-coms went public. Do they belong under the retail sector or are they technology stocks? We go through that exercise quite frequently to really figure out who owns a certain stock in terms of it being in their portfolio. In my case, it evolved over time. And in the early innings, the technology PM and myself shared, let's say, Amazon, because at the time it wasn't yet clear that this would be an entirely new sector. Right. I mean, the likes of Amazon were basically, for a retail analyst, a black swan event. There was so much pressure to get this right that if me as a retail analyst was not going to understand what was going on and happening, it would have been career suicide. If I had not advocated for owning Amazon, I would have just given up myself looking back, because how can a retail analyst miss that? So in a way, I used my retail expertise, my understanding of how the consumer works and how consumer trends happen and shifts in behavior happen amongst consumers. And the tech PM then gave their input in terms of how these businesses scale in the back end from a technology perspective. So we shared some of these big names in the portfolio.
Can you walk us through that Amazon decision that you made as a bit of a case study so that our listeners can understand a little bit of the process of what it's like, getting to know one of these companies and making a big decision to invest?
Okay, so that was back in 1997. It was in the thick of the 90s .com bubble. Mm-hmm. So for those listeners that lived through it, it was basically, I always say, every noun gets a .com. So within a short period of time, toys.com, cars.com, beauty.com all went public. And then there was the inevitable bust. Amazon went public way after these companies. And it hit the scene, I think, when the .com bubble was deflating. And so I was sitting in my office and I was really over the hype of sitting in on these IPO roadshows of unsustainable business models. I was just exhausted. And then our Morgan Stanley banker calls me, who was a good friend of mine, and he says to me, please, Kat, we have a guy called Jeff Bezos in town who runs a company called Amazon. He's in New York City and we can't fill the schedule. Can you take a double slot? And I'm like, oh God, hard pass. Selling books online. Barnes and Noble's got it covered. I mean, and with books, margins are a joke. So I made this compromise and I'm like, okay, my analyst will cover for me. So the day of, this was in our New York office. I was working at Pequot at the time, fund run by the late Art Sandberg, and our main office was in Connecticut. And so I worked out of the New York office, and it was a smaller office. So the day of the meeting, I just swing by the reception to say hi to our banker because he was a good friend of mine. And there's Jeff Bezos, and there was just this laughter. And he was telling a story to the banker and he was just cackling. And I'm like, oh my God, this guy's actually funny. So I just decided right there to stay for the meeting because I just needed some comic relief that day. And it was really 2 transformative hours. I can't really explain it any other way. There is something really magnetic about him. And I remember walking out of the meeting and calling our trading desk in Connecticut and saying, stop everything. We have to buy every single share of this company that we can get. And for the next 3 weeks, I remember I was like an Amazon groupie because your IPO allocation depends on so many factors. It depends on the size of your fund. It depends on how many one-on-one meetings you show up in, how many breakfasts you go to. Oh, wow. I must have gone to every breakfast, every lunch, and every after hours meeting with Amazon just to up our allocation because I was just so blown away. So I always tell this story and I say to myself, gosh, you were so close to missing the biggest seismic shift that has ever happened in your sector since big box retailers, since Walmart. I don't know. I mean, I don't even think you can compare Amazon to anything else. So, right. Yeah.
Well, Kat, what's so interesting to me about that story is you talked about the discipline and the rigor and knowing the companies and knowing them inside and out and knowing every little piece of them. But your story about Amazon paints almost a little bit of a different picture because you talk about charisma and you talk about that je ne sais quoi that Bezos had in those meetings and his laughter and how funny he was. And it's really interesting to me to see how much that factored into you believing in the company and wanting to be such a big investor relative to the more rigorous fundamental analyses that you were walking us through earlier.
Absolutely, yeah.
In publicly traded companies.
I think that it brings up a very important part of investing, and if I may say so, a very female-centric part of it, which is intuition. I think I went into that meeting and I walked out with this gut feeling that, you meet a handful of people in your life where you just know. You can't explain it. You just know that they're going to do big things. And that was the feeling that I had that day. And that's also brings me to something that's really very relevant, I think, in our discourse is that there is something that women bring to the investing world that is pretty unique. and that is their intuition. I have worked with so many women that have proven to me that this is really something unique to us. And I think that day it was that gut feel where I said, I don't care that these are books. I love Barnes and Noble. I was living on the Upper West Side at the time, and boy, that was this beautiful, beautiful, huge Barnes and Noble on 70th Street, I think, by the subway. And I would spend my Sundays there, and I was so determined nothing can take this away from us. But I knew deep down this is something big. And he went on the road show basically claiming he was selling books online.
Mm-hmm.
So,
well, I think it's interesting because in the venture capital world, it is so much about you're betting on the founder, you're betting on the person. I mean, nowadays companies aren't going public if they're not, they need to be more mature. They need to have a sort of more proven business model. Amazon went public, and to your point, they were still at that point, like they were not the everything store yet. They weren't, it took them years to ultimately even get profitable after they were public. So I do think that when you're investing in those earlier stage companies, it's like kind of a different thing. But nowadays, for people who are in the public investing space, you're probably not going to have the opportunity. Maybe a little bit, because David did say that a lot of what he does in the tech world is like he is meeting with these private companies. So he knows kind of who's in the pipeline to ultimately go public so that he will get that allocation. But the companies that are going public are doing it at a later stage versus you were making that bet, almost investing more like a venture capitalist in a little way. Like
yeah, I think that's a very good point. I've never thought of it that way, but there are several companies where we made investment decisions and there was really not a solid business model on the table when they did their IPO. And Amazon was definitely one of them. Like I said, all they were selling was books. You know what it was? Jeff Bezos cackling. And it's like that laughter, you can't resist. Your days are, you're stuck to your screens and all you see is red and green all day. And then you're like, God, this guy, I just got to go in that meeting. It's just like comic relief for me.
Nowadays, it seems that so many of these tech companies are going public so much later. I guess this is maybe more of a tech focus. I know you're consumer retail, but I'm just curious, do you think that there's maybe less opportunity for some people who are focused in equity long short, and not even just actually in the tech sector? It's like we have Shein going public on, I think it's the London Stock Exchange this week or next week or something. But I guess the question is, if you're investing in public equities and you have a lot of these companies that a lot of the high growth is almost like going to private equity, does that potentially cause less opportunities, or not necessarily, because at the end of the day, there's volatility in the markets and you can always find a good investment if you really understand the company?
So that's a good question. So one thing that's really different now and interesting as well for me is that there is much more volatility in large cap stocks. You would never have a Netflix be up or down 15% on a single day in the 90s. You would not have a large cap stock make those moves. So I think what's happened is that has enabled hedge funds to basically grow their capital and still be able to move performance in the right direction, because you have volatility in these larger cap, higher volume stocks. And that's very different. And that's really interesting to me. I think Meta reported last night in the aftermarket, the stock was up 10%.
Yeah. Yep.
For a company of that size, that's unheard of in the late 90s, early 2000s. So I think there's a lot more capital to work with right now in order to create alpha in your portfolio. Now, going back to your questions about the IPO market.
So basically, just a lot of companies are now, because there's such a highly liquid market for companies that are private, for employees who have options or, stock, to basically sell out. So like their only liquidity is not just an IPO. And a lot of companies are staying private for longer. You have Stripe, you have SpaceX. I'm trying to think of some of the other big guys. There was something, I heard a stat, which was crazy, that there's like 1,200, and I could be wrong. I probably should look up the exact number, but something like 1,200 unicorns, right? So companies that are private with a valuation over $1 billion, whereas it used to be that those companies would go public before then. And now they're staying private for so much longer. So it just seems like for people who are investing in the public markets, you don't have the option to kind of get in on the ground floor and ride all the way up. But again, to your point, you do have potentially more of that volatility once they are public.
Yeah. And I mean, I can't speak for the private sector. I'm so highly specialized that I just sort of play around in my own little narrow group of stocks. I have never run out of opportunities in that sort of list, my watch list. There's always something I can buy, there's always a point where I can sell. It has really been something I have benefited from just being very, very concentrated.
I know that you're the judge of Bill Ackman's annual stock pitching
One of them.
challenge, one
One
of the
of them.
judges. And I was reading through some of the criteria that you use to evaluate those pitches. And you talk about emotional investment, analysis, and risk management. And I'd love it if you could walk us through the weighting of each of those components and how you think about an individual pitch.
Yeah. So before I start talking about that challenge, I just want to really a shout out to all the young and aspiring investment analysts that are in business school right now trying to get into the business. Judging that challenge is like my Super Bowl. I go there every year and I'm just blown away by the talent and the analysis and the rigor and the innovation that these students bring to the table in terms of finding original information to basically separate themselves from consensus, which is really how we as judges pick the winner. Is how does your investment thesis compare to what's out there and what consensus is? So it's very exciting to see the rigor there. So how do I judge the challenge? I looked at sort of something called the emotional investment chart. And my focus is really sort of ideas that capture the point of maximum financial opportunity, stocks that are currently out of favor, where sort of, like I said, panic has pushed prices lower. If one of the groups is just simply presenting an idea that has a 10 or 15% return, that to me is like not of interest. I really want to see ideas where the market has pushed the price of the stock way below where it warrants the company valuation to be. So that's where I start. And then I really like pitches where analysts handle large volumes of data. And this is a very critical part of what I look at is how are they integrating that data with anecdotal and grassroots research. So have they gone out and done their own sort of pedestrian journey in terms of learning what this company is really about? So, for example, this year we had one of the groups pitch Pool, symbol POOL. They are a swimming pool manufacturer and they also install pools around the country. And they had literally mapped out the demand for swimming pools across the country using such large volumes of data and shown us the overlap. And it was really, really impressive what they had done. So that's one of the things I really look at. And then I look at risk management. Have they shown a clear demonstration of best case and worst case scenarios? Have they tested their thesis? I'm a big advocate for ignoring market noise and coming up with original stock ideas that way. So as long as the students recognize that long-term investing is about recognizing real value where others don't, I think that you really have a winning pick. And so far, our picks have done pretty well. So that's exciting.
Talking about long-term value, what was kind of the average time frame within which you were holding positions? And obviously, I'm sure that varied position to position. But I'm curious, was the life cycle of an investment a year? Was it a month? Was it, we have this target and when it hits it, and we're going to be patient and just wait?
Yeah. So let me go back to some of the investments that were in my big portfolio.
When you say big portfolio, I'm just curious, what are we talking in terms of capital?
So at my peak, I think my book of business was $1 billion.
Mm-hmm.
Yeah. But that was at my peak.
And how levered up was that?
Oh gosh, I think we were between 20 to 30%.
Okay, another quick editor's note here. When Kat says 20 or 30% leverage, she means that for every $1, you have an additional 20 cents of leverage. She says that they didn't actually lever up the retail portfolio very much. Right now, she runs a book of business with about 30% leverage. And one thing that we didn't really cover is that in equity long short hedge funds, the more important risk metric is exposure. Whereas, for example, zero exposure means that the portfolio has equal amounts of long and short positions, thereby neutralizing market risk. Her exposure as sector heads running her own book was something that she decided based on the dynamics in the market and the portfolio and would make those decisions on a daily basis. But leverage is a decision that the head of the fund would usually make to manage the overall portfolio. Risk management was therefore kind of a team process at the hedge fund, and the trading desk would work closely with the head of the fund to determine that.
So, like analysts often have that stock that made their career. And my forever stock has been Costco. So this was before the .com, before Amazon. Retail was really high growth back then. You had the big box retailers like Home Depot, Bed Bath & Beyond, Lowe's. Very exciting times, lots of square footage. And before that, there was Walmart, and then came Costco. It's not sexy. It's not tech. It's sort of a boring business, but it was just such a well-run company. What I really loved about the Costco management, and this is going back to the dynamic duo, Jim Sinegal and Richard Galanti. So that was the CEO at the time and the CFO who just recently retired. I think they are the unsung retail heroes. Basically, I started investing in that stock in the mid 90s, and I've held on to it until today. And it has been such a stellar performer. And it's really due to a management team that understands their consumer. When it was part of the big portfolio that I ran, it was my number one position. I would fly out to Seattle, where their headquarters are, every 6 weeks. And instead of sitting in a boardroom with Jim and Richard, we would go out and do these store visits. And oftentimes, because people knew who Jim was, it was sort of in disguise, and that was a lot of fun. And
like undercover CEO.
Undercover CEO. And the understanding of their business that these two have and still had was so remarkable that this is a great example of how a buy-side analyst actually gets exposure to management in a way where they really can see how this management operates. So outside of the boardroom, outside of the big conferences, the Wall Street conferences, I was always hitting the pavement with these two and saw firsthand how they view and run their business. And it was all bottoms up research. Really, that is what kept me going with this company.
Oh, that's so cool. I actually have a question. My understanding is that now a lot of these funds try to stay at very low betas. So you're long, but then you're also short in almost like equal amount. Was that the case back then? Or was your book basically almost like even in terms of long and short? Were you more long focused? I was just curious how that breakdown was at the time.
Yeah, so I actually had a nickname on Wall Street, the Grim Reaper, because one of the traders at Pequot gave me that name because so much of my idea flow was on the short side, because oftentimes the life cycle of consumer stocks and retailers is limited. And that's fertile ground for finding short ideas. And I also taught a seminar at Columbia Business School on short selling. So that's really up my alley. And I always tell my analysts that understanding how to sell short a stock is also a great exercise for being long, because when you do sort of the analysis for going along a stock, you oftentimes have to look at the best and worst case scenario. And the worst case scenario is oftentimes what lends itself to be having a short idea. We actually, in all the portfolios that I ran, didn't use short selling as a hedge. It was really part of our investment philosophy and part of our investment strategy. And it is a very draining and exhausting part of being a hedge fund analyst, if that is the kind of strategy that your PM basically expects from you. And again, the fact that the retail sector lends itself to short ideas, it was always a lot of pressure on me to come up with those ideas, but I also enjoyed it. I loved it. That's where your sort of investigative hat comes into play, like financial frauds, lying about fundamentals. I'll give you a couple of exciting examples. So as retail analysts, we used to, again, go on the road a lot, visit stores, really try to do all this grassroots research to support our thesis. And there was a company in the early 2000s. Again, I was at Pequot at the time, Rexall Sundown. They made vitamins and supplements. This was in the early innings of the whole supplement industry becoming huge. And they came out with this one product called, oh God, I hope I get this right, but I don't come for me if I don't. Glucosamine chondroitin.
Okay.
And the stock, if you looked at the chart, the way the stock moved was in terms of how much of this glucosamine chondroitin they were selling. I think it was something for bones. And then at some point, which is really a clear indicator of short-term success for every consumer stock, Walmart started to carry their product. And I think the stock went up like 60% on that announcement. This was obviously a company that was not so well run. It was sort of a one-shot pony, as they say. So how do we do the research here? The stock kept on trading against us and we kept on adding. And it was really so exhausting and a huge heartache for me to be able to underwrite that position and keep on telling my boss, let's add because this thesis is really solid. So at some point he said, Kat, the risk profile of this position is unwarranted at this point. We don't know. This could, with a short idea, things can go, into infinity, really. That's the risk you take. So I said, all right, let me go on the road. So my analyst and I went on the road and we hit I think 4 or 5 cities. And we went to the Walmarts and we parked our car and we went to the back of the store. And at every one we went to, we saw these boxes, Rexall Sundown, lined up. They couldn't even fit them into the warehouses behind the Walmart stores. So we came back with a really clear indication that the company was stuffing the channels and they had filled the pipeline with the product. And 2 quarters later, the stock collapsed. So yeah. That is one of my short stories. And there are many like that, but I do not recommend going into that business. It is,
well, I think
the reward is tremendous, but there is so much stress and agony that comes before it.
And I was going to say, I almost feel like it's getting more dangerous these days too, because you can have a team of Redditors who decide we're going to take down this hedge fund and we're just going to force them so that they have to ultimately short squeeze, buy back the stock. And even if the thesis is right, it's you can't hold on long enough because a team of Redditors is going to try to take you down with the whole GameStop and AM's. There's been some of those situations. So I don't know, the shorting definitely feels like it could get risky. But to your point, this was a company that they were clearly not doing as well and stuffing those channels. But it is interesting that, to your point too, which is nowadays you can't just necessarily go to the store because a lot of it's going to be at the Amazon warehouse. So you don't necessarily, you can't see all that backlog necessarily unless you can get into Amazon warehouse somehow. But
there is so many stock ideas that I have written up for my sons to hopefully read one day that are based on tools that we don't have anymore. We can go through reviews on Google, we can look at Google searches, but at the end of the day, there was nothing like actually seeing the story evolve
Yeah.
on a grassroots level.
Right.
How often, if at all, did you use derivatives outside of just plain vanilla equities, long, short trading to express ideas like that, where maybe a put option could have obviously limited some downside?
I never did any of that. I really tried to constantly build my expertise in my sector as a growth and sometimes a value investor, but most of the funds that I worked with were growth investors. So the trading desk would take over all of that for me.
So they would decide the expression of the trade?
Yeah, they would
Meaning you said,
structure the trades.
oh, interesting.
Yeah.
So you would just say, okay, here's where the stock is trading. Here's my target. You go out and figure out the cheapest and best expression of this view.
Yeah, not always, but if there was a lot of alpha, then they would do that. But we were always very plain vanilla long short US equities. And like I said, I think there are not many US equity hedge funds now that actually use fundamental short selling as an investment strategy. I even know of a couple that don't use it at all anymore. I think it is really, what is your return on your emotional well-being and your time of being a
Yeah.
short seller, especially in the era of Reddit. I mean, we didn't have
Yeah.
Reddit, but we had armies of investors that would go after stocks with a high short interest, and that data was available every Saturday in Barron's at the time.
Yeah.
So that was also not easy, but nothing like Reddit.
Yeah.
I would not want to get in front of the Reddit train.
The closest comparison I can think of to you going to the back of the Walmart warehouses is what's going on with Chipotle right now, where all these analysts are going into these Chipotles and weighing out the servings that they're given to see if portion sizes are in fact shrinking and all that fun stuff.
Listen, this type of mindset is really, really important. So
Yeah.
I'll give you another example, Theranos, which actually you could argue that every sophisticated investor before investing in Theranos should have just gone to their local hospital or their primary care physician and said, is it possible to get this entire blood panel with a drop of blood? And you would have been surprised because everybody would have told you it's impossible. And this was not a public company, but I remember reading the fortune story about Elizabeth and thinking to myself, that was another time where I had this feeling that I had when I met Jeff Bezos, but it was sort of the opposite. I'm like, something is fishy about this. She's on the cover of Fortune, and her company was valued at $1 billion. At its peak, it was $9 billion. I remember. And so I just registered myself at 3 local hospitals here in New York, and I went for a blood draw, and I asked the phlebotomist, the technicians taking the blood, I said, is this possible? And all 3 of them at 3 different hospitals said, you're talking about that crazy Theranos test, something to that point. And so this was really simple. Like you said, all you need to do sometimes is just pay attention. And I always talk about this concept that I've created for my trainings back then, the idea of the backseat of the plane. So obviously, hedge fund, it's a very glitzy and glamorous business, and you get a lot of perks when you work in it. And it can easily pull you away from making good investment decisions. If you're just going to run around in fancy circles and interact with VIPs, you're not really going to know what's going on the grassroots level. So I always recommend whatever mode of transportation you have available to yourself, take the subway, walk a lot, and if you're going to take a plane, sit in the back. And that's obviously the cheapest and least comfortable place to sit. But there's so much anecdotal evidence you can pick up just by sitting in the back of a big plane and going on a trip, because you can watch what people are wearing on their shoes. You can eavesdrop on conversations. You can watch what people look at the minute they have Wi-Fi access again. And for me, that was always a surprise because everybody opened up their phones to Instagram. And so I knew there was something coming up with Facebook when I saw that. And so this kind of insight you're not going to get if you're traveling on private airplanes and on yachts, which is our mode of transportation on Wall Street, really. So I always try and pay attention to the mainstream Americans, the mainstream consumer, and stay relatable. It's so important to stay relatable. That's one of the things I see gets lost very quickly with success on Wall Street, and remain humble. And I think those that have managed to do that have remained great investors.
Yeah, it's so interesting because if you think about investing, you might just think, well, I need to look at the financials, I need to build my model. And it's like, no, there's so much more than that. Management's going to talk about whatever they want to talk about in their 10K, but you have to actually get out there and you have to see what people are doing. And I think we talk so much too about just how AI is going to change the landscape. And at the end of the day, it's like the AI is as good as the data that goes into it. And you don't necessarily know what the data is. So you want to get out there and be like, I want to actually have boots on the ground and figure out, does what I'm seeing make sense? Does this jive?
In journalism, they call it shoe leather journalism, like boots on the ground. So another example of that is a more recent stock, Kava. And like you mentioned, Chipotle. Kava is a really interesting story. And the way it started to get my attention is because I have one son who's in college in Boulder and another one in Palo Alto. And when I go to visit, I'm obviously always observing what's going on because New York City is not a great,
it's not necessarily representative.
It's not representative of the rest of the country, but Boulder is, Denver is.
And the rest of the country doesn't live in like 1,200 square feet of a building.
Yeah, exactly. So I started seeing there were huge lines outside of Kava. So I really was amazed. I'm like, this is like a Mediterranean concept. It started to grab my attention, and it has been a phenomenal stock since its IPO. Maybe overvalued now. You can debate around that. I don't want to give any stock tips on this podcast.
No investing advice
but
here.
I want to just give you sort of a very quick and more recent example of how these observational tactics and paying attention can really help. And people are really more into their protein intake and their macros. And if you go on Kava's website, they're pretty accurate about their calories. They do not underreport them. And like I said, lines out the door. And that's important.
So you just made reference to your two twin boys, right?
Yeah.
They're twins. We get asked all the time, what is it like navigating becoming a mom at the upper echelons of Wall Street? And we can't tell you because we both had our children after we exited our Wall Street careers. But you did it and had the sleepless nights of having twins and also being short stocks, which the combination of the two, I mean, I need an anti-anxiety medication just thinking about it. Can you walk us through what that was like and give us some context, because our only exposure to what the hedge fund world of the 90s and early 2000s was like is really through movies. I started covering hedge funds in 2006 and already it was a different world than it was in the 90s. What was that like becoming a mom at the upper echelons of arguably the most competitive and most male-dominated segment of an already male-dominated industry?
When people ask me that, I think it's hard for me to answer that because my experience was so positive, but I have mentored over the years so many women that have had such difficult experiences with the transition to motherhood. So let me start by telling you about mine. So I was working for Richard Perry at Perry Capital when I became pregnant with my twins. And my twins' due date of any day of the year was December 20th, which is usually the last day you work before the end of the year. And then you want to try to close out the year because what shows up on your P&L on January 1st is what you get paid. So this was very poorly planned. And then I had a very difficult pregnancy and was on bed rest. Oh. And I have to say, Richard basically did everything he could to make this as easy on me as possible. I had 3 screens that he somehow installed in my home. And this was before
like remote
work from home. Yes, that was not even, there was no such thing as work from home when you worked on Wall Street. And then I went into labor, and with twins, I had to go back home and couldn't go to work right away. Again, I was given everything I needed and a tremendous amount of support. I decided to go back to work pretty much a month after my twins were born,
Wow.
and obviously hired a nurse, and I was able to work 2-3 days at the office. And that I did that for I I think 7 years,
Wow.
Wow.
the first 7 years of my kids. And really, the impetus was my accountant who said to me, and this was great advice: your kids won't remember you from the age of 1 to 10, but then things get really consequential. So if you want to push work, do that in that first decade of their life. So I basically took that advice, and for me personally, it worked. But
Mhm.
what happened is, I do think that I missed out on some of their big milestone moments because, as you know, working on Wall Street, you don't go home at 5 p.m. It's a 24/7 job. You don't have vacations. I remember going on vacation with 2 Blackberries, never being able to shut off my mind because you've got so much capital at risk. How are you supposed to say, oh, I'm going to be taking off for a week?
Mm-hmm.
And the same thing happened at home. Like, I'd be bathing my kids, and then my BlackBerry would buzz. A company reported news after the market closed. It wasn't anticipated. I had to get on a conference call with the investment team, and those things started to happen more frequently. And I realized that I would not be able to do my best work if I had so much capital I was overseeing. And then I transitioned to becoming an independent investor and have been running sort of my own family offices since. But I have to say, if I look back, I worked for Julian Robertson, Steve Mandel, the late Art Sandberg, and Richard Perry, 4 icons of this business, and they were all fiercely loyal. And my experience was extremely positive. The reason I left the business on a larger scale was completely personal.
Mm-hmm. And I'm curious, you talked about the women that you've mentored who had different experiences. And without sharing any of the details from their experiences, what do you think thematically is different about those who had negative experiences transitioning to motherhood versus yours, where you had this unwavering support and deep dedication from the heads of your funds?
I think it's what you hear typically on Wall Street, that there's not enough support for women that want to go into motherhood because they are competing. I mean, especially on the buy side, competing against men who are able to stay on track with their investment portfolios.
Mm-hmm.
And it's as simple as that. Women can't. Women go into labor. Pregnancy is not always an easy path for every woman. Women still carry the bigger emotional load of raising a family, and investing is a very emotional exercise.
Mm-hmm.
So I think all of that plays into the equation. And I do want to say something else that I personally did not experience, but that my female clients who work on Wall Street do often experience. And this is the story that I've heard several times, but I'll give you a specific one. I had one client who came up with a great investment idea at the bottom of the market. She had her thesis lined up. She presented it to me, and I picked it apart, and she knew it so well. It was Netflix, when the stock collapsed a year and a half ago. And she went into her investment committee, presented it. And if I remember this correctly, one of the male analysts said to her, well, you would understand Netflix because isn't that what your kids watch all day? Like, these microaggressions that because you're a woman, maybe your investment thesis isn't that solid and it's related to your personal experience as a woman.
Which, by the way, sorry, I just have to say, I mean, it's funny because we were talking about Disney earlier, and like part of the reason where I was like, I want to buy Disney is because I see my kids and how much they watch. Like, by the way, that actually
is the
like
same investigative journalism that you're talking about. This is the boots on the ground. It sounds like, hey, guess what? I'd be like, that's my secret weapon. I know what my kids and all other kids are watching. So what have you brought to the table lately? Like, what research have you done?
Exactly. But if you went into some of these meetings and said, okay, here's my investment thesis, these are all the variables and all these data points, and grill me on it, and you answer all the questions, and then Disney is the stock that you are presenting, and someone at the table says, well, of course you know the potential of the stock because your kids watch Disney all day. The idea behind it is really like, you're a
It's
woman.
no, well, I feel like it's
Can you
actually even
really
more
come up with
loaded.
a
It's
valid, can
even,
you really come
yeah.
up with a valid investment idea? And actually, I see this kind of aggression on LinkedIn a lot as well. Like men questioning you in terms of your ability to do something that they feel they typically should do.
Yeah, I mean, we see these types of, I mean, because we're obviously in the social media world and we see some of those types
Mhm.
of comments levied against people. And I actually think that the comment about your kids watch Netflix all day is actually even more insidious because is it insinuating that, like, oh, you're off working and you're not watching your kids, so now they
You
have to
leave
watch
them in
TV?
front of
Like,
the
it's
TV.
just, like, it's really messed up. But I actually wanted to go back to something because I really want to highlight a few things you said that our listeners may not be aware of. Because if you haven't had kids, I think it's something that you just don't understand. So you mentioned that you were pregnant and you had to go on bed rest. This is actually something that happens to a lot of people because
Mhm.
you don't want the baby to come early, very common to
Mhm.
twins. And so, in order to try to prevent a premature delivery, which can have devastating outcomes, you literally can't walk. It's not like, oh, you're no, it's actually miserable. Bed rest is like the worst thing ever. So I just
Mhm.
want to say that. You also mentioned going back to work after 4 weeks. Average maternity leave in the US is 12 weeks, which is pitiful. My brother, I've talked about how he's moving to Edinburgh.
Mhm.
Paternity leave there is 6 months. A lot of other countries, it's like a year. So you went back after 4 weeks.
Mhm.
That is like, also, I think speaks to, my guess is probably that you wanted to get back. You sort of seem like you loved what you did. And so
Mhm.
I feel like that probably came through. But I don't know what the situation was like for pumping. But when we talked to Zoe Cruz, who was the president of Morgan Stanley, she had said, she's like, I didn't nurse. That was a choice that she decided to make. Men don't have to make that choice. And so I just want to reinforce that it's for women, they do end up having to decide, like, if you go and you end up having to pump and it just becomes this whole thing. You also mentioned how, like, investing is emotional. And I do think women carry such a heavy load for their family. And I noticed this myself too, where it's like sometimes when I'm working, if I'm upset by something or fixated on something, then when my kids need the emotional support, it's like I just don't have it to give to them, and or vice versa. So there was so much that you highlighted that was interesting that I do think speaks to some of the problems and like structural issues that are just in place, and some of which, again, unfortunately, are biological realities. Like a guy, unfortunately, they might want to help nurse, they can't. It is what it is. But it sounded amazing that you were working for people that said, hey, I see you on bed rest. How can I make your life easier so that you can do what you want to do? So anyway,
Yeah.
there was so much you said there that I
I,
thought
I,
was
ha- I
just
have to
so,
really, I
yeah.
really have to applaud a lot of the leadership in the hedge fund world for that. And as I said, I'm really privileged to have worked with so many women whose experiences were so different from mine. So
Yeah.
I can speak to that as well. And yeah, I worked for people that were incredibly flexible, who saw the value that I brought to the table and who made space for that. But you're right. Whenever I get this question, and I get it all the time, how can I succeed as a woman in this industry once I have children? I don't have a great answer because, like you said, the biological reality for us is just so different.
Now, we just talked about the experience of motherhood as a
Mhm.
distinctly female one. I'm curious if you're comfortable speaking about this. I understand that you are also a cancer survivor, that you had
Yes,
stage
yeah.
4 lymphoma. I lost my mom to lymphoma. And I mean, I know what it was like navigating her medical treatments. How on earth did you navigate going through such a major health challenge while in such a high stress role?
I'm sorry to hear about your mom. Did she have non-Hodgkin's?
She did. Yeah.
Yeah. I had the young adult version, Hodgkin's disease. And
Mm.
when people ask me this question, it was only more recently that I realized that the diagnosis I had was in 2000, and it syncs up with the late 90s, where again, it was this seismic shift in the retail sector on Wall Street, and whether there was a correlation between the stress that I was under at work and this diagnosis. And I'm not saying there is, but I'm also not saying there isn't. So I just want to put that out there. Lymphoma can be caused by anything, but it's sort of suspect that it was right after the dot-com bust, which was basically, we were working 24/7 that year. There was so much going on. Now, my experience was a little different, and this is the first time I'm actually publicly sharing this. I started to have a lot of fatigue in 1999. We always got to the office by 6:30 because our morning meetings were at 7:30, so we wanted to be prepared and see what happened overnight and go through the sheets. I remember it started to become really difficult for me to get to the office at 6:30, but I pushed myself. And then there was a period in November, I remember, where I didn't wake up. I was just like, my alarm went and I slept through my alarm, and it was like 9 a.m. And that had never happened to me. So I kept on calling my assistant and saying to her, I'm at a breakfast meeting. And I think at one point she's like, how many breakfast meetings are you going to in November? It's like the end of the quarter. So I wasn't fully upfront, but I was so ashamed of not being able to get to the office at 6:30.
Right.
And that was probably one of the first red flags that something was going on with my body. At the end of that year, when I got my comp and I was actually made partner, I was at Pequot back then, and the late Art Sandberg, such a wonderful man, was my boss. And I said to him, I need to take a sabbatical. I really was so drained. And so I went on a sabbatical and I was made a partner and I was able to celebrate that. But the symptoms just got worse and worse. And then, like with a lot of young adult cancer patients, there's a delayed diagnosis. So I was walking around with all these symptoms for a year because no doctor is going to say to you, oh, you may have cancer. It was either dermatitis, a virus, depression, anxiety, all of the above, but it was never cancer. So by the time I was diagnosed, I was really, really ill, and I was stage 4. And so I wasn't even working on Wall Street. I was on sabbatical. And then really I had to tell Art that I don't think I would be coming back. And then I spent 2 years battling this disease. And then as I was recovering, thank God for Memorial Sloan Kettering Cancer Center, I was able to go into remission. And during my remission, a friend of mine called me and said, do you want to have lunch? So he was working for Richard Perry at Perry Capital. So I went in for lunch thinking it's just him and I having a casual lunch. And by the end of the lunch, Richard walks in and he introduces himself. He's such a nice person. He's like, well, would you consider coming and helping us build our retail desk here at Perry Capital? And I looked at him. I said, I only came here to have lunch. I don't think I ever want to work again. No. And then he's like, well, we'd like to make you an offer to come back and work. At the end of the day, he had me sign a contract. Like it was just like, and that was like my last and final stint on Wall Street. And that's when I got to finally run a $1 billion book. And he supported me throughout my pregnancy and through motherhood. And then when it came to a point where I couldn't give it my all, I said to him, let's part ways. But I was still a consultant. But I do want to say one more thing, is that while I was undergoing cancer treatment, I started to build up sort of just a research consulting firm, Rondeal Research Group, I called it. And every one of my former employers became a client. So I am so grateful. Like when I say fiercely loyal, I have to say I commend some of the people in this business for their loyalty, really. And that brings me back to what I do today, which is, helping other high performance professionals deal with these cycles of self-doubt. I mean, Wall Street professionals, the way, like you say, they're portrayed in TV shows and in the movies, they're like walking around brimming with self-confidence. That is such a fallacy. We actually deal with so much self-doubt. I mean, I've been now investing for 30 years and I've worked for some of the most legendary investors. And if I have a quarter where my performance is not in line with the market or is just really disappointing, I feel like I am just a complete fraud and I'm useless at what I do. And this kind of recency bias where you base your self-worth on your last stock or your last investment really dominates the mindset of this industry. The higher the stakes, the bigger the fall.
I think that's really insightful. Any final advice that you would give our listeners who are aspiring investors in either the equity long, short, hedge fund world or otherwise?
Yeah, so I think that, again, very simple advice, just pay attention. It's amazing what you can learn that applies to investing if you simply talk to people, watch and listen to whatever comes across your desk or your screens, and have humility about it. When I think back to those investment dinners I was invited to at the 21 Club. I don't think it exists anymore.
It doesn't exist anymore.
Does it not?
No,
Really?
it closed. It's where I had my 21st birthday dinner.
Really? At the 21 Club?
Yeah.
So for the listeners who don't know, the 21 Club was like a Wall Street institution. Yeah. It's where high-level investors would have their idea dinners and investor meetings. Dinners, and whenever I would attend one of those idea dinners with like celebrity investors, I would try to tune everything out that I heard and just enjoy the dinner because it was not helpful for my investing practice at all to listen to what others do. And that's why I always say tune out the noise and run your own race. Like really pay attention to regular people. That I think has been my mantra for most of my investment career. And the other thing to remember is like everyone is a long-term investor at the top of the market or when a company reaches its peak stock price, but few believe in that company when the price falls. So understanding that is really important in terms of investing. And yeah, I try to put out content on LinkedIn, which is sort of my natural habitat. I live on LinkedIn. I also have a website at Greene with an E at the end, Greene Street Coaching. That's the street I live on in New York City. It's a beautiful street. It still has cobblestones and old architecture. So if you're ever in New York, come and take a look. My content is Kat Sosnick on LinkedIn, and it is also where I publish a column every Tuesday on finance and every Thursday on productivity and a newsletter on Fridays. And then on Saturdays, I just post a blurb about life in New York City. That's really the best place to also connect with me. If you have any questions or any follow-up, I love mentoring women and men as well.
Oh, that's phenomenal. We'll put all those links in our show notes. Thank you so much, Kat. We really enjoyed chatting with you. Thank you so much for sharing your stories. And hopefully this episode is going to air in real time on Saturday.